Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey. Welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. I am Austin Wilson, research analyst at Hicks & Zerker Capital Management.
And I'm Josh Robb, director of wealth management at Hicks & Zerker Capital Management. Austin, how can people help us with our podcast?
We would love it if you'd subscribe. If you're not subscribed already, so hit that plus, follow icon, whatever that is on your podcast player so that you get new episodes when they drop each and every Thursday. And visit our website, because on our website, you can sign up for our weekly newsletter to get notified with a nice little summary and a nice link to listen to that episode. It's exclusive on our website, so check that out. But today, your episode is coming in hot.
This is it.
It's coming in hot because we're going to be discussing the implications of the Fed likely having made its last hike of this hiking monetary cycle. Crazy tightening we've experienced as opposed to easing or loosening of monetary policy, which they did during COVID. They've ramped it up, tightened it up, and right now we're sitting at about 90% chance that it's done. We're no longer going to get any more hikes.
Yep.
So what are the implications for the market there? And I guess we should also point out the Fed is saying once they're done, which is now-ish, they're probably going to leave rates where they are through the end of the year.
Okay.
That's kind of their
That's
plan.
what they're
right
saying.
now. As a matter of background, 9 hikes spanning everything from 0.25% or 0.25%, 25 basis points, to 50, 0.5%, to 75, many
one.
of those in a row.
Yep.
And then back down to 50, back down to 25 is kind of the way that they've done this path. So 9 hikes from March of 2022 through May. We just got the last, hopefully, one, May of 2023. It has been in the top 2 fastest monetary tightening cycles on record for the Federal Reserve of the United States. Ever.
Wow.
Arguably, I would say the fastest if you look at it from a interest rate change comparison. So in terms of where you're starting, so because we started at 0, essentially, or almost 0 is the way the Fed would have seen it. If you look at the percent change on that almost 0 number, it is an exponential increase.
It changed from 0, yeah.
It was almost 0.
0.25?
But even if they increased the same amount and interest rates were 8% or 5% at the beginning, your percent change would have been a lot smaller. So I think it was a bigger shock to the system this time.
I could see that.
Than it has been. So if you consider where we started, craziness, and that is fastest and hardest monetary tightening cycle ever. What did it do? Mm-hmm. It caused a bear market. Mm-hmm. It caused stocks and bonds to fall apart in 2022, and both have yet to recover in 2023 thus far. It may, we're not so sure about this, but it may be in the process of causing a recession. There are a lot of things that are pointing towards slowing down of an economy, although we, as a first quarter GDP, it was still positive, but slowing anyway. So one thing we do know, and we're going to talk about this a little bit later, is that the Federal Reserve usually does not stop early enough, and they usually break something and cause some sort of recession. Now I want to talk about what this means for the markets, because we're in kind of a weird position where, okay, maybe some uncertainty around the Fed hiking cycle is behind us, but how do markets typically fare when we get to this point? We're going to break this down. But if we look at the last 4 Fed rate hike cycles, the S&P 500 was sharply higher 1 year later after the last hike, 3 out of the last 4 times.
Okay.
That's pretty decent chances.
That's good news.
So in other words, it generally didn't pay to fight the Fed. However, what is the interesting thing here, during the dot-com bubble, you had sharply lower returns a year later after. So that was the one time period where you had some pretty rough returns after.
Yep.
And that's because
a year later from when they ended, other things happened between that time frame too that could have been a factor outside of that.
This is purely looking at data.
Yeah. May 16th of 2000, there was turmoil that followed a year later from that.
Yeah, so let's break down briefly those 4, the most recent 4 hiking cycles ending periods. So one of them ended on February 1st, 1995. 1 year later, the market was 30% higher. Mm-hmm. The next one ended on May 16th, 2000. So this is the dot-com one. That one did go on for 10% further downside a year later for the markets. One ended on June 29th, 2006. That one had markets higher by nearly 20% over the next year. And then the one that ended on December 19th, 2018, I remember this one. Markets, they sold off sharply through the end of 2018, almost a bear market in like a month. And then a year later, they were higher by 20%.
They were higher like
it was
4
crazy.
months later.
Yeah, it was crazy. It was crazy. So 3 out of the last 4, pretty impressive. One of them, not so great. Okay. So one notable fact is that this cycle has shown that actually the market going into this last hike has actually been down the most. So if you look at the 12 months leading up to the last hike, the market has been down the most of all of these. So we're in a little bit different situation here, as in it's been more painful, I think, due to the rate of change that we had talked about on the front end. And it's kind of unknown as to what that's going to lead to now. So there has been really one instance where the Fed has not caused a recession.
Soon to be the second.
And we're hoping we get another one here. Yeah, Mr. Optimism. So 1994 and 1995, that tightening cycle, the Fed brought inflation down, but stopped before they broke the economy.
Oh, nice.
That is the only example of the Fed hiking cycle not ending in a recession. So usually these end in a recession. That's, again, the only time. So their track record's not so great. And it's to be determined if they A, gone far enough or B, gone too far, but it's unlikely you're going to get this is not going to be like a Goldilocks-y thing in most instances. Okay? So more often than not, like I said, Fed causes a recession. In some cases, it was really quick. 1981, 2000, the economy in both those times fell into recession within a few months.
Of them stopping hiking.
Yeah, exactly. In a couple other cases, like 89 and 06, it took well over a year for that to happen. Now, how does that correlate with stock market returns? It's a little bit nuanced. The S&P 500 over a long period of time, now we're stepping back beyond the prior 4, but over a longer period of time, the S&P 500 has been lower most of the time that this happens. Now, it has been, like I said, higher more recently, but lower over a longer period of time. If you look in the 6-month period after the last hike, so narrowing that a little bit more, on average over the long period, not just the last handful, the S&P 500 has actually been down 5.5%. So
post their stopping.
Again, it looks a little bit better, but we look a little bit further back, it actually looks rougher. One of the things that is a key thing to remember is that it's a recession call that really matters. So if we're in a recession or heading into a recession imminently, the market's going to be selling off anyway. And one thing that the market has really been thinking about a lot is the prospect of Fed cuts. The market's pricing in Fed cuts later this year, second half of the year, a couple of them anyway through the end of the year. And that sounds like a good thing for lower interest rates for really stocks and bonds should benefit from that. But it's really not for the right reasons. It's because of economic weakness. And that is actually not going to be a good prospect for stocks. When the Fed actually cuts rates, it's because things look bad.
They're doing it for a reason. They're cutting rates for a reason.
Sucks. And that's actually almost always really bad news for stocks. So don't be banking on the Fed cutting being a buoy for the stocks. If the Fed cuts, that's actually, you got other things to worry about at that point. What about stocks versus bonds after the last hike? Are bonds more attractive than stocks? Are stocks more attractive than bonds? If we look at all the last hikes since 1953, stocks have underperformed bonds 6 months after, on average. Now, even during the rising rate environment of the 60s, the 70s, stocks were behind bonds in the 6 months after every single time. But the interesting thing is that 1 year later, we had very wide dispersions of returns. So it's really hard to pinpoint exactly what this is going to look like because you've had stocks versus bonds having a difference of one outperformed the other by 10% 5 times and one underperformed the other by 10% 4 times. So like big number swings. So
in other words, it wasn't one or the other. There was a lot of times
mixed.
But when they do, they outperform by a decent amount, one or the other. So you just have to guess it right.
But overall, stocks have outperformed bonds 8 out of the last 13 times. And then again, if we look a little bit more short-sighted here, so since 1989, stocks have outperformed in the immediate time frame after that last hike. So that is kind of, again, the only example where things were really rough was 2000. Generally speaking, things have been pretty good since then. So long story short, the Fed hiking cycle's over, probably. What does this mean? It means that historically speaking, in the short term, we could have a period where the Fed's not hiking and the Fed's not cutting, so there's some uncertainty off the table, and you're not getting big changes in interest rates, so that's viewed as favorable. So you could have some tailwinds for stocks specifically to do okay. It's a little bit more nuanced whether that stocks or bonds are outperforming in the short term, but you could have a short period here where stocks could actually perform okay.
Okay, gotcha. Let's pause and do a dad joke.
Ooh, I like it.
And we'll swing back into this question on the rate hike cycle and kind of get on what's going on with the markets.
Yeah.
All right. So, don't know if you know this about me, but years ago I applied to an art school.
Did you?
Yeah. My focus was going to be on origami. Yep. They sent me a rejection letter.
Yeah.
I don't know what to make of it.
Don't know what to make of it.
Because it's origami.
Yeah. Have you ever tried to sit down and make origami?
Yeah.
It's stressful. There's a lot of little folds.
Yes, but I also could see that as one of those things where it takes your mind off of other things because you got to concentrate on this stuff.
Oh, yeah.
Right? And so you're not thinking about anything else. Similar, like I watch people doing other things where it's intensive, but it's also just following directions, right?
Yeah.
To me, if I needed just a distraction, that could be one.
Right.
I would probably be super frustrated when it was all done because it wouldn't look like the swan I was trying to make.
I know I've tried to do those and I'm like,
But,
this is not right.
yeah.
Something's not right.
I could see myself enjoying that. And if I needed just turn my mind off of everything else and focus on one thing that isn't something I normally do.
Yep. That's what I do when I go out to the garage. It's my origami.
That's what I was thinking. Like building to
I'm
me,
going to break
is what it is.
something probably. I'm going to bust a knuckle up, but I'm going to have one thing to focus on.
Yep. Building is what it is for me.
Yep.
That takes a lot of my concentration to work on that project. But yeah.
Absolutely. All right. Let's talk a little bit about why the market environment that we're in could also have an impact on this. So here's some definitions. Secular bull is really talking about a longer term bull market without a sustained multi-year bear market drawdown in the middle. So many would actually say that we're still in a secular bull market and have been in since 2009. Okay. So it's a longer term bull without a sustained drawdown. Secular bears are multi-year bears being substantially below the all-time highs with no serious rebound. A lot like the time period. There have been multiples of these, but the most recent one would be tech bubble, 2000, all the way through right before the global financial crisis.
Mm-hmm.
You pretty much had a lost decade.
Yeah.
That's a secular bear market, right? Mm-hmm. And then you've got shorter-term thinking. So a cyclical bull market is a short-term bull market. So this can be, within a longer-term bear, you can have some multiple cyclical bulls. And a lot of people use like a 20% rally from a recent low or something like that for a short-term bull market there.
Yep.
Then you can have a cyclical bear market, and that's a short-term bear market, and that can be within a longer-term bull market. So if we're still in this longer-term bull market, we're hoping that what we're in now is a cyclical bear market. It's a short-term one that'll rebound to all-time highs before too long. We also experienced one of those in COVID where we had arguably the fastest rebound of all time, but that was definitely a bear market. It just rebounded very, very quickly and did not stay down. So those are some definitions. So what we need to talk about is the tendency that after the final rate hikes in secular bull markets like we think we are in right now, markets have actually had a tendency to rise. And this is an interesting thinking where, the Fed's kind of done. Market should be, historically speaking, more likely in a secular bull market to continue some upward momentum from here just because the net optimism is out there. It's kind of the way to think about this. Because we've not been in this beat down bear market for years, we've been in it for a little while, but it hasn't been super deep and it hasn't been super long yet. The going on theme is upward. We're still in a bull market over a longer term. Upward thinking, positive momentum should come in over time there. So that's one thing to think about there. Now, again, there can be puts and takes within these longer term thinking. And if we retest the October lows and even go lower and stay down for a long period of time, that secular bull that we think we're in can turn into a secular bear. And that would be obviously very bad for stocks, of course.
Right.
So markets actually tend to fall after the Fed rate hike. If we're in a secular bear market, we're probably at that point in a secular bear market because things are terrible in the economy. Something's already broke. Like the tech bubble, we had valuation issues and unprofitable companies and all kinds of crazy things going on, as well as other economic weakness at the same time. So you had a double whammy of weakening economy, overvalued market, causing years to catch up from that. The global financial crisis, we had their own issues as well. Now that was, the part of the secular bear market that we had been in. However, it took many years, but we still rebounded beyond that and got into a new bull market from there. But if we're in those periods where optimism is not there, the market does not want to default up. We're not in a longer term, optimistic thinking, growing mindset in terms of the market. That's typically pretty poor for forward market returns. So again, there's a tipping point we're at right now. If the market does not rebound somewhat soon, we may threaten this longer term secular bull market that we're in and actually cause further downward pressure and really some serious pessimism in the markets. So that is going to be directly impacted if the Fed breaks something with their hiking cycle that is ending right now. So again, as a reminder, we talked about earlier, the Fed may go too far. Historically speaking,
they do.
They do. All except for like one time. So what is the reasoning behind this? They're using a lot of lagging data, for one, to kind of guide what they're doing.
Economic data is lagging.
Yeah, of course.
So it's hard because
you don't know
you've got to wait for the data to show up before you make a decision.
And by the time
data is a month old.
Yeah, it's like driving from the rearview mirror to some extent, which is a little bit of a challenge that they have to face. So that's a tough part.
Unless you're backing up, then you want to use a rearview mirror.
Maybe the Fed just needs to go into reverse. But anyway.
You mentioned the secular bear and bull markets versus the cyclical, which are the short term. Do you think we're still in a secular bull market right now?
I would say yes for now, especially if we're still within 20% of the all-time highs. If we dip below that, and if we really test last October lows or even like pre-COVID highs, that would be really bad. I would start feeling like there may be some years before we recover from that. Also, the economy is key here. So that secular bull is going to be threatened by a serious recession. If the recession is serious, because most people, and I would say that myself included here, would say a recession is coming at some point. Maybe it's later this year, maybe it's next year, who knows? If the recession is serious, if it's deep, if there's a bunch of unemployment and all of this stuff, we are going to have a serious issue for stocks, which I would say would cause potentially a break in the secular bull market to turn into a secular bear. Could take some time to recover. Even if we get a recession, if it's relatively mild, I don't think that has to break.
Okay.
And I think that that's kind of what the Fed hopes for. They're not saying it. They're saying that the recession is not their base case. However, I think in their minds, they're like, hey, if we have a mild recession, it's not the end of the world. We have 3.4% unemployment. How bad can it really get? So that's kind of where I think we are right now. But the real question, Josh, that I want your opinion on is, okay, so we got our last hike. We're in a little bit of an unknown period, right? We don't really know what's happening economically for certain. We know it's not terrible, but it's not great in certain areas. We know markets still have not recovered. How does this impact your financial plan?
Yeah, mine personally.
Yours personally.
Yeah. So when I'm talking to clients, this question is asked a lot, right? With everything going on, what do I need to do to change? Do I need to adjust my plan? And usually the answer is no. The overall plan, especially when we're talking long-term planning, is you should expect and anticipate multiple movement in the market up and down along through your plan, as well as you're going to get some recessions, because recessions happen as part of our economic cycle. To see them every 6 or 7 years, you get these slowdowns and these movements within an economic pattern are normal. And so should you change your plan because we got a normal occurrence within a longer term? No, you really shouldn't. Can you do things differently during that time? For sure. If the markets are going down, one of the best things you can do is increase your contributions during that time frame. And, if you need to tighten your budget, if you're on the other end of withdrawals, maybe adjust your withdrawals when the portfolio is down. But overall, it really shouldn't factor into your plan. Your plan should have a long-term thought process that has been tested, that through these economic cycles, it doesn't impact the overall success. And that's really what a good plan looks like.
So if you have questions about what is happening, this is a great time to talk to your advisor, because they'll be able to say, hey, either A, here's an opportunity to take advantage of right now, or B, we built this into your plan. We did Monte Carlo simulation with 1,000 different options of the way this could go.
We already simulated movement.
We're doing better than the worst case there.
I will say there are certain situations where you may need to tweak your plan. For instance, if you were hoping to retire and the market's down. If you have that flexibility and desire, maybe waiting a year or two and working is great.
Right.
If you have that flexibility and freedom. It doesn't mean you have to, but it just may improve your results.
Yep.
So there are times, depending on what you're doing, where, yeah, it's worth looking at it. There's nothing wrong with asking that question. But more often than not, the answer usually is stick with the plan. This doesn't impact what you're trying to do.
That's what I would say.
Yeah.
Stick to the plan, man. All right. Well, thank you for listening. Hopefully this was able to give you some peace that, hey, it's going to be all right. Stick to the plan. But we do have some uncertainty out there, and we don't necessarily know day to day what the market's going to do in the short term. But over the long term, we know that stocks rise because people spend money and earnings rise,
That's right.
So that's what we know over the long term. But thank you again for being here today. Hopefully you learned something. If you know someone who is asking about some of this discussion, share this episode with them. We'd love it if you do that. Always remember, we'd love it if you'd subscribe or leave us a review on Apple Podcasts or Spotify. And check out our social media accounts on Instagram, Twitter, Facebook. Say hello. We'd love to see you there.
That's right. Talk to you later.
Until next Thursday. Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.